What if I told you that the successful trader you admire on TV is probably just a lucky idiot? What if I told you that the brilliant CEO on the cover of a magazine owes their success more to a random coin flip than to their supposed genius? And what if I told you that your own brain is a pattern-seeking machine that is actively, constantly, and convincingly lying to you about why things happen in the financial markets? It sounds like an insult, doesn't it? A cynical and dismissive view of a world we're taught to believe is driven by skill, intelligence, and hard work. How could the entire edifice of financial news, expert analysis, and market forecasting be built on a fundamental misunderstanding of reality? The answer is simple, and it is the most intellectually liberating and deeply uncomfortable truth in all of finance. We are storytelling animals living in a random world, and we are profoundly skilled at confusing good luck with genius. We see a winner and invent a story about their skill, and in doing so, we ignore the vast, silent graveyard of people who had the exact same skills but were simply unlucky. This is the core explosive insight of Nassim Taleb, a former options trader, a brilliant polymath, and the most ferocious intellectual brawler of our time. He took a flamethrower to the sacred cows of Wall Street and academia, not with opinions, but with a deep understanding of probability, history, and human psychology. He showed us in the world of finance, we are all, to some degree, being fooled by randomness. Welcome to Capitura. Today, we are not just reviewing a book. We are taking a red pill. We are going on an audiobook-style journey into the book that started it all, the foundational text of Taleb's entire worldview, Fooled by Randomness, the hidden role of chance in life and in the markets. This is not a summary of investment strategies. This is an inoculation against nonsense. It is a guide to developing a skeptical, probabilistic mindset that will act as a permanent shield against the gurus, the forecasters, the storytellers, and most importantly, the biases of your own mind. Stay with us, because the ideas in this book will change the way you see the world. They will expose the illusions of skill that surround us, reveal the true nature of risk, and provide a framework for not just surviving, but thriving in a world that is far more random than we are comfortable admitting. Introduction: The Rogue Philosopher Wall Street. Nassim Taleb is not your typical finance author. He is a force of nature, a Lebanese-born multilingual, fiercely independent thinker who spent 2 decades as a quantitative options trader, a pit trader, and a hedge fund manager. He wasn't an analyst sitting in an ivory tower. He was a practitioner who made his living and a fortune by betting on the rare, unpredictable, high-impact events that the rest of the financial world ignored or pretended didn't exist. He had skin in the game. His experience in the trenches of the market gave him profound contempt for what he calls the empty suits, the economists, financial journalists, and academic theorists who build elegant models of how the market should work, without ever having to bear the consequences when those models inevitably blow up in the face of reality. Fooled by Randomness, first published in 2001, just before the dot-com bust reached its nadir, was his opening salvo in a war against this intellectual charlatanism. The book is not a dry, academic text. It's a sprawling, personal, and often arrogant collection of essays, anecdotes, and thought experiments woven together by a single, powerful theme. We systematically overestimate the role of skill and underestimate the role of luck in our lives. And nowhere is this delusion more dangerous than in the financial markets. Taleb argues that our brains are wired for a simple, primitive world of cause and effect. This wiring was great for helping our ancestors survive on savanna, but it is disastrous when applied to complex, random, and wild environment of modern finance. We are desperate to find patterns, to create narratives, and to believe in a just world where success is a predictable reward for skill. The market, however, is not a just world. It is a place where a lucky fool can be crowned a genius for a time, and a brilliant strategist can be wiped out by a single, unpredictable event. So, why does this book, written at the dawn of the 21st century, matter more today than ever before? Because the machine for producing and celebrating lucky fools has become exponentially more powerful. Think about the culture of cryptocurrency. Social media is flooded with stories of people who became overnight millionaires by buying a random altcoin. This creates a massive illusion of skill, a powerful form of survivorship bias. We see the one winner, not the 99,999 people who lost everything on similar bets. Taleb's work is the antidote to this distorted view of reality. Consider the narrative fallacy that drives the hype around a stock like Tesla. We create a heroic story around its visionary CEO, and this powerful narrative can blind us to the enormous risks and the role that lucky timing played in its success. Taleb teaches us to be skeptical of stories and to focus on the range of possible outcomes. What about the intense FOMO that fueled the meme stock craze? This was driven by seeing others post their spectacular gains, leading to a desperate fear of being left out. This is a direct result of being fooled by randomness, mistaking a lucky outcome for a repeatable strategy. Even the seemingly safe world of the FIRE movement, financial independence, retire early, built on passive investing in ETFs, is not immune to Taleb's critique. A strategy based on a century of historical market returns is a form of induction, assuming the future will look like the past. Taleb's most famous concept, the black swan, is a warning that rare, unpredictable, and game-changing events can and do happen, rendering the past an unreliable guide. Fooled by Randomness is not a book that gives you easy answers. It's a book that teaches you to ask better questions. It challenges you to look at every success story, including your own, with a healthy dose of skepticism, and to ask, how much of this was skill and how much was just dumb luck? In the sections that follow, we will explore Taleb's most powerful ideas. We will visit the silent graveyard of failed traders to understand survivorship bias. We will deconstruct our brain's addiction to storytelling. We will learn the crucial difference between the mild randomness of Mediocristan and the wild randomness of Extremistan. And we will discover how to build a mindset that is robust in the face of a deeply uncertain and unpredictable world. This is not just a book summary. This is an intellectual toolkit for surviving the 21st century. Let's begin. Chapter by chapter breakdown, a thematic exploration. Nassim Taleb's book is not a linear textbook. It's a meandering philosophical journey. To capture its essence, we will explore thematically, looking at the core pillars of his argument, one by one. Part 1. The Invisible Graveyard, Survivorship Bias, the Timeless Principle. Taleb starts his assault on our illusions by introducing one of the most powerful and insidious mental biases, survivorship bias. The concept is simple. We make judgments about the world based on the people and things that have survived, and we completely ignore the things that have failed. The failures are silent and invisible, leaving us with a dangerously distorted picture of reality. His classic example is the successful fund manager. Imagine a world where 10,000 ambitious people start trading. In year 1, by pure luck, 5,000 of them will have a good year. In year 2, 2,500 of them will have another good year. After 5 years, about 313 of them will have had 5 straight winning years. After a decade, we might be left with just 1 or 2 managers who have had a perfect track record. What happens next? The financial media descends upon these survivors. They are put on the cover of magazines, hailed as the next Warren Buffett. Gurus analyze their every move, trying to reverse engineer their genius. Investors pour billions of dollars into their funds, believing they have found a master of the universe. But as Taleb points out, in a large enough initial pool, the emergence of these geniuses is a mathematical certainty, even if every single one of them was making decisions based on a random coin flip. We see the one spectacular winner, but we don't see the silent graveyard of the 9,999 other traders who followed similar strategies and were wiped out. Their stories are not told. Their faces are not on magazine covers. They are invisible. This bias is everywhere. We study the habits of billionaires, assuming their routines are the cause of their success, ignoring the millions of people with the exact same routines who are not billionaires. We look at ancient buildings that are still standing and marvel at their brilliant construction, forgetting the countless other buildings from the same era that collapsed centuries ago. In finance, survivorship bias is not just an intellectual curiosity. It is a machine for generating sucker bets. It creates an endless parade of gurus and hot strategies that are often nothing more than the temporary winners of a giant lottery. The amateur investor, fooled by randomness, chases these past winners, buying their funds or copying their strategies at the absolute peak of their performance, just before their luck inevitably runs out. Modern takeaway. The modern digital world has put survivorship bias on steroids. Social media is a perfectly curated highlight reel of success, a place where the silent graveyard is more silent than ever. The world of cryptocurrency is perhaps the most extreme example. During a bull market, your Twitter and TikTok feeds are filled with stories of people who turned a few $1,000s into millions by buying a new altcoin. This creates an overwhelming illusion that making money in crypto is easy. You see the one survivor who bought the right coin at the right time. You do not see the silent graveyard of the hundreds of thousands of people who lost their life savings on the thousands of other coins that went to zero. Taleb would argue that the entire crypto influencer space is a giant engine of survivorship bias, designed to lure in new waves of investors who will become the next residents of that graveyard. Venture capital and tech startups are another classic case. The media is obsessed with the unicorn companies that achieve billion-dollar valuations. We hear endless stories about the genius of their founders. But for every one of these successful startups, there are thousands that failed. The investment strategy of spray and pray, investing in hundreds of startups hoping one will be a massive winner, is a direct admission that the game is dominated by randomness, not predictive skill. Yet, the narrative we are told is always one of heroic genius. The Robin Hood culture of posting gain porn, screenshots of massive, often options-fueled profits, is a direct injection of survivorship bias into the veins of the market. It creates a powerful illusion of easy money and encourages others to take on absurd levels of risk, hoping to replicate a result that was, in all likelihood, a lucky outlier. Taleb's lesson is a call for profound skepticism. The next time you see a story of incredible financial success, your first question should not be what is their secret, but how many people tried the exact same thing and failed? By mentally populating the silent graveyard, you can begin to see the world with a more realistic and probabilistic eye. Part 2, the narrative fallacy, our addiction to stories. The timeless principle. After revealing the invisible evidence of the silent graveyard, Taleb turns his attention to a flaw deep within our own minds, the narrative fallacy. This is our innate and deeply human tendency to create stories to explain complex and often random events. We are uncomfortable with randomness and uncertainty, so our brain, our left hemisphere, to be precise, acts as an interpreter, constantly generating simple, linear, cause and effect stories to make the world feel more coherent and predictable than it actually is. Taleb argues that this storytelling mechanism is the source of most of our misunderstandings about the financial markets. Turn on any financial news channel. If the market is up, a reporter will confidently say, "The market rallied today on optimism about a potential interest rate cut." If the market is down the next day, the same reporter will say with equal confidence, "The market fell today due to renewed fears about inflation." Taleb calls this post hoc rationalization. The story is always created after the event to fit the facts. It gives us the comforting illusion that we know why things happened, but it is a complete fiction. The market's daily wiggles are the result of millions of complex interactions. They are essentially random noise, but our brain cannot accept this. It demands a story. This fallacy extends to how we view success. We see a successful CEO and the media constructs a heroic narrative about their visionary leadership, their relentless work ethic, and their brilliant decisions. We conveniently ignore the lucky breaks, the random meetings, the competitors' unforeseen mistakes, and the macroeconomic tailwinds that may have played a far larger role. The story is always cleaner and more compelling than the messy, random reality. The narrative fallacy is dangerous because it leads us to believe the world is more predictable than it is. If we think we know the story of why the market went up yesterday, we are more likely to believe we can predict the story of why it will go up tomorrow. This false sense of understanding leads to overconfidence and excessive risk-taking. As Taleb famously says, we use the past to tame the future. Modern takeaway. The modern media landscape is a non-stop, high-volume narrative machine, making Taleb's warning more urgent than ever. The hype cycle of individual stocks is a perfect example. Consider the narrative around Tesla. The story is powerful and emotionally resonant. A visionary genius is single-handedly saving the world with electric cars. This story is so compelling that for many investors, it replaces fundamental analysis. They are not investing in a car company. They are investing in a heroic narrative. Taleb would argue that this is incredibly dangerous. It makes investors blind to the real risks, competition, production issues, key person dependency, because those facts don't fit the clean, heroic story. Financial news and social media are in the business of selling narratives. A headline that says market moves randomly, no one knows why, doesn't get clicks. A headline that says market plummets as fear gauge hits record high does, because it provides a simple, emotionally charged story. A Taleb-trained mind learns to see these headlines for what they are: entertainment, not information. They are just stories we tell ourselves to feel better about a world we don't control. The meme stock phenomenon was driven almost entirely by the narrative fallacy. The story of the little guy versus the evil hedge funds was so powerful that it convinced thousands of people to invest in fundamentally broken businesses. They were not buying a share of a company. They were buying a role in a compelling story. When the story changed, their investment thesis collapsed. Taleb's lesson is to become a narrative skeptic. When you hear a story explaining a market move or a company's success, your default response should be to question it. Ask yourself, is this a real causal link, or is it just a convenient story told in hindsight? How would the story be different if the outcome had been the opposite? By resisting the comfort of easy narratives, you can maintain the intellectual humility necessary to see the world as it is: a messy, complex, and largely unpredictable place. Part 3, Mediocristan versus Extremistan, Two Worlds of Randomness, the Timeless Principle. This is one of Taleb's most brilliant and important conceptual breakthroughs. He argues that our failure to understand randomness stems from the fact that we confuse two very different types of random environments. He calls them Mediocristan and Extremistan. Mediocristan is the realm of the ordinary, the expected, and the bell curve. It's a world where individual events are not very important. Examples: human height, weight, calorie consumption. Key feature: when you take a large sample, no single observation can dramatically change the average. If you put the 1,000 tallest people in a room, and then the single tallest person in human history walks in, the average height in the room will barely change. Predictability: the randomness in Mediocristan is tame. We can use statistics and bell curves to make reasonably accurate predictions. The past is a decent guide to the future. Extremistan is a realm of the extreme, the unexpected, and the scalable. It's a world where a single event can have a massive, disproportionate impact. Examples: wealth, book sales, social media followers, market crashes. Key feature: in Extremistan, a single observation can dominate everything else. If you put 1,000 people in a room to measure their average wealth, and then Jeff Bezos walks in, his net worth will be 99.9% of the total. The average will become meaningless. This is a world of winner-take-all effects. Unpredictability: the randomness in Extremistan is wild and untamable. The bell curve is useless and dangerously misleading. The past is a terrible guide to the future, because the future will be shaped by rare, extreme, black swan events that have never happened before. Taleb's devastating insight is that we live in Extremistan, but we are mentally and institutionally conditioned to think we live in Mediocristan. The entire financial industry, with its reliance on models like modern portfolio theory and the Black-Scholes formula, is built on the assumption that market returns follow a nice, neat bell curve. Taleb shows that this is completely wrong. Financial markets are not Mediocristan. They are pure Extremistan. A single day, like the crash of 1987, can have a bigger impact than the previous 10 years combined. Modern takeaway: the distinction between Mediocristan and Extremistan is the key to understanding the risks and opportunities of the 21st century economy. The internet and globalization have pushed more and more of our world out of Mediocristan and into Extremistan. An author in the 1950s was competing with a few hundred other authors in their country, Mediocristan. A YouTuber today is competing with millions of others for a handful of hyper-successful slots, Extremistan. Cryptocurrency is the ultimate example of an asset class born and raised in Extremistan. There is no average day. There are long periods of quiet, punctuated by explosive, face-ripping rallies and catastrophic 80% crashes. Anyone who tries to apply Mediocristan logic to Bitcoin, try and predict its fair value or its standard deviation, is making a profound category error. Its behavior is dominated by rare, extreme events. The stock market itself is a classic example. Most of the market's long-term returns come from a very small number of hyper-successful companies. A study by Hendrickson Binder found that over the past century, the best-performing 4% of companies accounted for all the net wealth creation in the stock market. The other 96% of stocks in aggregate did no better than treasury bills. This is a pure Extremistan distribution. It explains why a simple S&P 500 ETF works. You're guaranteed to own the handful of big winners that drive all the returns. Taleb's lesson is that you must first identify which environment you are in. If you are in Mediocristan, you can trust the averages. If you are an Extremistan, you must ignore the averages and focus all your attention on the extremes. You must be prepared for the possibility of a wild, unpredictable event that will change everything. Your goal should not be to predict these events, but to build a strategy that is robust to them or that can even profit from them. Part 4. The turkey problem. The limits of induction. The timeless principle. To illustrate the danger relying on past data in a world of Extremistan, Taleb uses his most memorable and powerful analogy, the problem of induction, framed as the story of a turkey. Imagine a turkey living on a farm. Every day, the friendly farmer comes out to feed it. Day after day, the turkey's confidence grows. It collects more and more data points, and every single one confirms its hypothesis. The farmer is my friend and exists to make my life better. The turkey's statistical model looks perfect. Its forecast for the next day is always more food and continued comfort. This trend continues for 1,000 days. Then, one day in late November, the day before Thanksgiving, something completely unexpected happens. The farmer arrives, but not with food. The turkey is about to experience a massive revision of belief. The turkey's error is that it mistook a lack of evidence of harm for evidence of a lack of harm. It relied on its past experience as a guide to the future, and this reliance was fatal. The 1,000 days of data were not just useless. They were actively misleading because they had a single rare, catastrophic risk that was invisible from the historical record. This, Taleb argues, is how most of the financial world operates. We build complex models based on decades of historical market data. We backtest trading strategies and find that they work beautifully in the past. We sell insurance-like products, like selling out of the money options, that generate a steady stream of small profits day after day. Just like the turkey getting its daily meal, we become more and more confident that our strategy is safe. But we are all turkeys. The past, especially in Extremistan, is not a reliable guide to the future. A strategy that has worked for years can be wiped out in a single afternoon by a black swan event, a market crash, a sudden geopolitical crisis, a technological disruption that lies completely outside the bounds of past experience. Modern takeaway. The turkey problem is a permanent feature of financial markets, and we see its consequences play out again and again. The 2008 financial crisis was a classic turkey problem. The big banks and ratings agencies had models based on decades of housing data that proved a nationwide collapse in home prices was impossible. They were collecting steady profits, selling complex mortgage-backed securities, confident in their models. They were the turkey, and September 2008 was their Thanksgiving. Quantitative trading strategies are particularly vulnerable. A hedge fund might design a complex algorithmic strategy and backtest it on 20 years of data. The backtest looks incredible, showing steady, consistent returns. But the strategy may have a hidden, fatal flaw that is only exposed by a specific type of market environment that hasn't happened yet. Many quant funds have blown up spectacularly when the market suddenly started behaving in a way that was not represented in their historical data set. Even a long-term passive ETF investor in the FIRE movement needs to have some humility about the turkey problem. The strategy of buying and holding the S&P 500 has worked brilliantly for a century. But is it possible that a future black swan, a major war, a climate catastrophe, a radical political shift, could cause the next 30 years to look nothing like the last? Taleb would not say this is likely, but he would insist that we acknowledge the possibility. The past is not a guarantee. The lesson of the turkey is not to become paralyzed by fear. It is to cultivate a deep intellectual humility. It is to understand the limitations of historical data and to be deeply skeptical of any strategy that relies on the assumption that the future will be a simple continuation of the past. It forces us to ask the most important question in risk management. What is the one thing that could happen that has never happened before that would wipe me out? Part 5. The Path to Robustness, Asymmetry and Stoicism, the Timeless Principle. So, if the world is dominated by unpredictable, high-impact events, how can we possibly succeed? Taleb, drawing on his experience as an options trader and his love of classical philosophy, offers a path forward. The goal is not to predict the future, but to build a strategy that is robust in the face of an uncertain future. This means positioning yourself to be protected from, or even to benefit from, randomness. The key concept here is asymmetry, or what he would later call convexity. A strategy has a positive asymmetry if it has a limited, capped downside and a massive, open-ended upside. A strategy has a negative asymmetry if it has a small, limited upside and a catastrophic, open-ended downside. Negative asymmetry. The turkey selling insurance, picking up pennies in front of a steamroller. You make small, steady gain, but you are exposed to a single event that can wipe you out. Positive asymmetry. The options buyer buying a cheap, out-of-the-money option. You lose a small, fixed amount most of the time. But on the rare occasion that a massive, unexpected market move occurs, your payoff can be 100 or 1,000 times your initial investment. Taleb's entire career was built on seeking out positive asymmetries. He was not trying to be right often. He was trying to be right big on the rare occasions that mattered. He was happy to endure years of small, controlled losses, waiting for the one black swan event that would lead to spectacular payday. Beyond the technical strategy, Taleb advocates for a personal philosophy of stoicism. The ancient Stoic philosophers, like Seneca and Marcus Aurelius, taught that we should distinguish between what we can control and what we can't. We cannot control external events, the market, the economy, the actions of others. But we can control our own thoughts, our own emotions, and our own reactions to those events. A Taleb-style investor is a modern Stoic. They accept the market's randomness as a fact of life, like the weather. They don't get angry or emotional when a trade goes against them. They focus only on their process, on executing their strategy flawlessly, and on behaving with dignity and rationality, regardless of the random outcome. This emotional detachment is the ultimate source of strength and resilience in a chaotic world. Modern takeaway. Taleb's ideas of asymmetry and stoicism offer a powerful and practical framework for the modern investor. The most direct application is the barbell strategy. Instead of taking on average, medium risk, you divide your portfolio into two extremes. The safe bar, 85 to 90% of your portfolio, you put the vast majority of your capital into extremely safe assets. In today's world, this might be treasury bills or a highly conservative, globally diversified ETF portfolio. This part of your portfolio is protected from black swan events. The speculative bar, 10 to 15% of your portfolio, you take the remaining small portion and invest it in high-risk, high-reward, positively asymmetric bets. This could be angel investing in startups, buying a small amount of highly speculative cryptocurrency, or even buying long-dated options. This barbell strategy is incredibly robust. The vast majority of your wealth is safe, but you still have exposure to a massive, life-changing upside if one of your speculative bets pays off. You are immune to the turkey problem and are positioned to profit from Extremistan. The Stoic philosophy is the perfect mental model for dealing with the constant emotional provocations of the modern market. When your meme stock investment goes to zero, the Stoic response is not to get angry and blame conspiracies. It is to calmly accept a loss as the outcome of a probabilistic bet, to learn any available lessons, and to move on. When your FIRE movement portfolio takes a 20% hit, the Stoic response is not to panic. It is to acknowledge that this is an external event beyond your control, and to focus on the one thing you can control: your commitment to your long-term savings and investment plan. Taleb teaches us that the ultimate victory is not financial, but psychological. It is the victory of achieving a state of inner tranquility and rational composure in the face of a world that is, and always will be, ruled by randomness. Modern context expansion. What would Nassim Taleb say today? If Nassim Taleb were to write Fooled by Randomness today, he would find himself in a target-rich environment. He would see the modern financial world as a grotesque caricature of the very intellectual sins he set out to expose 2 decades ago. His tone would be even more acerbic, his warnings more dire, and his contempt for the empty suits more palpable than ever. The tools of the trade, Robinhood, AI, and the Great Flattening. Taleb would view the democratization of finance through apps like Robinhood as a deeply dangerous development. He would see it as giving the keys to a Formula One car to a teenager who has only ever played racing video games. The illusion of knowledge. He would argue that providing infinite data and charts to amateurs doesn't make them more informed. It just makes them more confident in their own delusions. It allows them to spin more elaborate and convincing narratives to justify their random bets, a phenomenon he calls a narrative fallacy on steroids. The celebration of lucky fools. He would point to the culture of posting gain porn on Wall Street bets as the ultimate engine of survivorship bias. He would see the celebration of figures like Roaring Kitty not as a story of skill, but as a dangerous glorification of a lucky lottery winner, destined to inspire millions of others to buy lottery tickets and lose. Absence of skin in the game. He would be disgusted by the entire ecosystem of financial influencers on TikTok and YouTube who offer speculative advice without bearing any of the risk. He would see them as the ultimate empty suits, benefiting from the upside of their calls, while their followers suffer the downside. When it comes to AI-based investing and quantitative models, Taleb would be their most formidable and vocal critic. He would not be impressed by the complexity of the algorithms. Instead, he would relentlessly attack their fundamental flaws. The Turkey Problem 2.0. He would argue that AI models, which are trained on historical data, are the ultimate turkeys. They are exquisitely tuned to the randomness of the past, but are completely blind to the possibility of a future black swan that lies outside their training set. He would say that AI is great at navigating Mediocristan, but finance is Extremistan, and that's a fatal mismatch, the charlatanry of backtesting. He would mock the entire practice of backtesting, calling it a form of sophisticated data mining. He would argue that with enough computing power, you can always find a strategy that would have worked in the past, but that this has zero predictive power for the future. Fragility, not robustness. He would warn that a world where everyone is using similar AI models creates a dangerously fragile system. When a black swan event does occur, all the models will react in the same way at the same time, leading to a catastrophic flash crash. The modern strategies, index funds versus day trading. Taleb's philosophy provides a sharp and often uncomfortable lens through which to view today's most popular strategies. He would have a complex and nuanced view of index funds. On one hand, he would appreciate their humility. An index fund investor is admitting they cannot predict the future or pick winning stocks, which he would respect. He would also see that a broad market index like the S&P 500 has a degree of positive asymmetry, as the upside of the few big winners, the Apples and Googles, can be unlimited, while the downside of any single company is capped at a 100% loss. However, he would also be deeply critical of the blind faith many investors place in them. He would warn that the strategy's success is based on a century of American economic dominance, a classic case of the turkey problem. He would caution that a passive strategy does not make you immune to a black swan event that could cause the entire market to stagnate for decades. He would advocate for a more robust barbell approach over a simple 100% equity strategy. He would view modern-day trading as an activity for fools. He would see it as a desperate attempt to find predictable patterns in the random noise of the market's daily fluctuations. The narrative trap. He would say that day traders are the ultimate victims of the narrative fallacy, inventing a reason for every tiny wiggle and convincing themselves they are skillful. Negative asymmetry. He would point out that the structure of day trading is often negatively asymmetric. Traders tend to cut their winners short to lock in a small profit, but they let their losers run in the hope they will come back, exposing themselves to potentially large losses. The domain of suckers. He would argue that the short-term market is dominated by high-frequency trading firms with a massive speed and information advantage. An individual day trader is like an amateur poker player sitting down at a table with the world's best professionals. They are destined to lose. Timeless principles as a shield against modern risks. In our chaotic modern world, Taleb's ideas are not just a philosophy. They are a practical survival guide. Survivorship bias as a defense against hype. The next time you see a 22-year-old on TikTok explaining how they made $1 million on a new cryptocurrency, Taleb's voice in your head should whisper, "Where's the silent graveyard?" This simple question is a powerful shield against the hype and FOMO that drives speculative bubbles. The barbell strategy as a defense against black swans. In a world of increasing complexity and unpredictability, the barbell is the ultimate robust strategy. By keeping the vast majority of your assets safe and making a few small, high-risk bets, you make yourself immune to prediction errors. You are prepared for any outcome. Intellectual humility as a shield against hubris. The most important lesson from Taleb is to be humble. Humility in the face of randomness is the beginning of wisdom. It stops you from over-investing in a single sure thing. It encourages you to diversify, and it forces you to focus on what you can control, your process, your risk, instead of what you can't, the outcome. Nassim Taleb would conclude that the modern world has become a perfect storm of his ideas. Technology has amplified both the randomness of Extremistan and the psychological biases that make us so vulnerable to it. His work is no longer just a critique of the financial world. It is an essential guide to thinking clearly in the 21st century. Closing reflection. 10 timeless lessons from Fooled by Randomness. As we emerge from our deep dive into the skeptical and brilliant mind of Nassim Taleb, we are left with a powerful new set of intellectual tools. His work is not a comfortable journey, but it is a necessary one. It strips away our most cherished illusions and forces us to confront the world as it is, a place governed by profound and often terrifying randomness. Let's distill his philosophy into 10 timeless lessons. Luck is a master of the universe. Especially in fields like finance, the role of chance is far greater than we admit. Do not be too quick to attribute success to skill, especially your own. A lucky fool is still a fool. Beware the silent graveyard. What you see is not all there is. For every celebrated winner, there are thousands of invisible failures. Actively correcting for the survivorship bias is essential for a realistic view of the world. Your brain is a deceitful storyteller. We are hardwired to create narratives to explain random events. Learn to be skeptical of these stories, especially the simple, clean, and emotionally satisfying ones peddled by the media. The past is not a reliable map to the future. The turkey problem, a long period of stability and success, does not rule out the possibility of a future catastrophe. Be wary of any strategy that relies solely on historical data for its claim of safety. Know if you are a Mediocristan or Extremistan. Most of what matters in life and finance happens in Extremistan, where rare, extreme events dominate. You cannot use the tools and assumptions of the gentle, bell curve world of Mediocristan to navigate this wild territory. Focus on the consequences, not just the probabilities. A low probability event is not a no probability event. If the consequences of that event are catastrophic, you must protect yourself from it, no matter how unlikely it seems. Seek positive asymmetry. The barbell strategy, don't be a turkey, collecting small, steady gains while being exposed to a devastating loss. Structure your affairs to have a limited, known downside and a massive, open-ended upside. Lose small, win big. Embrace intellectual humility. The beginning of wisdom is the admission of ignorance. True confidence comes not from pretending you can predict the future, but from building a strategy that is robust to your own inability to predict the future. Dignity is found in how you handle your fate. You cannot control random events, but you can control your response to them. Adopt a stoic mindset. Behave with courage, composure, and rationality, regardless of what luck throws your way. Demand skin in the game. Never take advice or forecast from someone who does not personally bear the consequences of being wrong. The most reliable information comes from those who have something to lose. So, how can you, the average investor, apply these profound and challenging lessons right now? It starts with a radical act of humility. Stop searching for gurus or systems that can predict the market. Accept that the future is fundamentally unknowable. This acceptance is not a weakness. It is a source of true strength. Next, adopt a barbell approach to your own finances. This is a practical way to put Taleb's philosophy into action. The safety bar, 85 to 90%, put the vast majority of your savings and investments into the safest, most boring assets you can find. This could be a portfolio of government bonds, or for a slightly higher risk tolerance, a globally diversified portfolio of low-cost index funds. This is your protection against the black swan. This is a capital you cannot afford to lose. The speculative bar, 10 to 15% take a small, fixed portion of your capital and place it in high-risk, positively asymmetric bets. This is your fun money, and you must be psychologically prepared to lose all of it. This could be angel investing, a handful of speculative cryptocurrencies, or other ventures. This strategy is incredibly robust. It makes you immune to the turkey problem. No single event can wipe you out, yet you still have exposure to the life-changing gains that can only be found in the wild world of Extremistan. You have structured your life to benefit from randomness rather than being its victim. Taleb's path is not one of comfort or easy answers. It is a path of skepticism, self-reliance, and intellectual honesty. It teaches us that the goal is not to be right, but to be robust. It is a philosophy for navigating a world that we will never fully understand, with our dignity and our capital intact. And there you have it, the sharp, skeptical, and essential wisdom of Nassim Taleb's Fooled by Randomness. It is more than a book about finance. It's a guide to thinking clearly in a complex world. It's a powerful inoculation against the hype, the narratives, and the intellectual shortcuts that lead so many astray. We hope this deep dive summary has challenged your assumptions and provided you with a new, more robust framework for making decisions. The principles we've explored today are a timeless defense against our own worst mental biases. If you found value in this breakdown of Fooled by Randomness, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be an intelligent investor.